Now, it's a good time to actually update the network on the large cap healthcare names, especially since we're seeing the last month, they've really caught a nice bid, given, I think, investors' concern with rising inflation expectations and, of course, any kind of tapering by the U.S. Feds kind of reeling in that bond buying program, kind of a key risk there as well. So let's first start with the key kind of topic here. Private hospital operator Ramsay, they made a cash splash, $1.8 billion laying out for UK Spire Healthcare yesterday. Now, effectively doubling their UK footprint is what it actually gives them, but really not a surprise to really, I think, anyone in the market that's been covering the name for a while. Now, we've been covering it over a decade. They've always talked about Spire being a natural fit for their business, so obviously they pulled the trigger, but we're kind of questioning why now. Spire, if you look at their history, has really suffered in the last 5 years. That stock's down over 40%. Really has suffered from really unfavorable government policies where the UK government is trying to alleviate, and then the best of their ability, the waiting lists for patients, and they have failed miserably in our regard to do that. And unfortunately as well, there's also supply side constraints, namely in labor, that haven't really been alleviated for that business. Now, all the nitty gritty details you can find in the note we published overnight, but really want to flag kind of three key points and highlights and takeaways and what you do with, of course, Ramsay now. First, we believe that the Spire shareholders will vote in favor of the deal. It was attractively priced for them, actually 24% above the last close of Tuesday before the announcement was made, and about a 50%, 48% to be exact, increase over the 180-day VWAP. So it looks attractively priced. We don't really see a counter offer coming in, really because private equity runs the ruler over this space. It was priced at an EV to EBITDA of almost 11 times, 10.9 to be exact. That is at the high end of what you should be paying for these type of companies, especially when Spire, as I said, has numerous kind of issues and have of late. So don't see private equity coming to play. We don't really see any other strategic buyers for this asset. So it's more than likely, I said, that the shareholders will vote in favor. The board has also shored up 30% of that registered, so it seems like almost a foregone conclusion. Given the vote, you should see in the next couple of weeks, there's a court sanction to go through as well. You think that this scheme would get up in about 8 weeks' time. Second, I would say the transaction, as I said, transforms the UK business, as I said, essentially doubling its footprint in the UK, doubling its profit as well. Now, Ramsay is will turn into a leading independent or private hospital operator in that geography, of course. However, the overall impact to Ramsay and the broader group is more modest. With cost savings, they're flagging of at least 26 million pounds. That equates to about 3% of Shire's cost base, or Spire's cost base, which I think is, what's on the conservative side, it's quite low. And we have EPS and return accretion looking into fiscal 24, so kind of in the out years as well. And third, I would say that the transaction is really subject to regulator approval. Now, this is where the rubber really hits the road here. The UK regulatory panels have been really sticklers of late to really get these things across the line. So we think that it's going to be very difficult as far as this transaction is concerned. What's going to happen? More than likely, Ramsay's going to have to divest some clinics and some hospitals. What does that mean as far as the accretion I'm talking to you about in 2024 and the return metrics? Don't know. So it's very, very hard to know exactly how this is going to play out. Definitely, there's going to be some divestors, as I said, because there's overlaps between these two businesses in their different geographies, and who knows what's going to happen. And that's going to take about a year process. So it's a time to wait for seeing where this is all going to flush out. We didn't make any changes. You've seen that note to our earnings or outlook for the name. Still have it on a hold rating. We've been saying for the last year that there's some concerns with Ramsay as far as the COVID trade. It's not a COVID trade. It's not a COVID exit name either. It's kind of sitting in this no man's land, and it has, in fact, tracked sideways, 60 to 68 in that range for about the last year. I said I like it below 60. And that's where I'm going to draw a line in the sand around 60, and it's very close to that now. So definitely a great operator. Not going to go away. Definitely a unique service that's needed, but I'm not going to buy it here given the uncertainty. I just want a little bit cheaper, and the $60 looks like a good level to pick it up. Moving on, sleep respiratory therapy company and our quasi-IT provider, Resmed. We put out a note yesterday on a competitor, Fisher & Paykel, put up kind of a dismal fiscal year end result, missing across the board. Now, we're willing to give them the benefit of the doubt as an analyst community, given that it's coming out of COVID, where everyone was being tested. So the analyst estimates are as good as throwing a dart at a board. So a miss there, neither here nor there. But where they created or caused the gravest sin was not to give fiscal 22 guidance at all. In fact, they actually went on to say that it's very difficult, and they gave a laundry list, literally laundry list of concerns, and from the vaccinations to the lockdowns to COVID variants to localized waves, all impacting the return to a stabilization in the hospital industry. And they even went so far as to say that it was unclear when and if other respiratory hospitalizations and surgical procedures will return to pre-COVID levels. Ouch. That's not, in my opinion, a good way to manage investor expectations, saying if it will return. I believe it will return. It's just a question of when. But to put that if in there, not a good look. But anyway, for Resmed, I think it's neither here nor there. It wasn't really a bad print because most of Fisher & Paykel management's comments was applicable to their hospital-based business, which is 80% of that business. Flip it around for Resmed. Most of its business comes out of the home-based market. So what Fisher & Paykel was saying about their 20% of their business, that home-based business, where things weren't that bad. Revenue was up 4% in constant currency. Management did flag signs of recovery in obstructive sleep apnea. Now, this is the main indication by which Resmed plays in the home-based setting. Of course, exiting Q4 for Fisher & Paykel, as I said, they see an uptick there. So I would say it bodes well for Resmed. We've seen a nice little uptick or increasing recovery there. The stock has had a nice bounce, Resmed that is, retracing kind of most of its loss coming out of the last quarter Q3 result. As I did flag going into there, there's going to be challenges as well in that quarter, but it has, like I said, retraced most of that. Continue to like the macro trends here. I mean, everyone's talking about respiratory medicine, digital healthcare, tick in those boxes. So still like that. Really like the medium-term outlook of this company. However, momentum, I'll let run for a while, play this name momentum-wise, but be cognizant heading into Q4. Here we go again. Don't want to have another repeat of Q3. However, more challenging than the last quarter. So that Q4 will play out the end of July into early August. So just be cognizant. Like I said, maybe let the near term run because we have a month to go plus. Let the stock just go where it's going to go. I think it's going to move higher, but be leery and tell your clients that Q4 heading into that result, you might want to take some off the table for fear that it would be a Q3 repeat. Okay, quickly turning now to pathology and diagnostic imaging provider Sonic. Nice bounce also, just like Resmed off of its low 30.50 back in March, now 36.50 roughly last month. Investors really gaining comfort, which is great to see with more of the testing regime. Obviously, it was a key beneficiary of the COVID trade, testing. And of course, as the vaccine rolls out, the testing will come down. That's a no-brainer. Of course it will. It's just how far down will it fall? I've always said it's not going to fall off a cliff. And I think people are getting more comfort with that, especially as you see these sporadic lockdowns, unfortunately, in Victoria, as we see number 4 guys. So sorry to hear about that. But this is going to actually pick up the testing and help beneficiaries like the Sonics of the world. So we still believe that the testing is still going to be supported. And we also have a very diversified business in Sonic. You have their base testing businesses is everything outside of COVID testing has been increasing. You have diagnostic imaging, which is another piece of the pie there that's improving as well. And you have clinical services, which is really your GP clinics and telemedicine, which has been increasing with consultations. Good to see there. Strong balance sheet. I've always said for Sonic, it really maintains good liquidity position, $1.3 billion in headrooms. This is the company you want to see do acquisitions, not necessarily the hospital operators, not to ping Ramsay again, but we're in the pathology place. It's all about scale efficiencies. You're going to see more acquisitions guaranteed. And Sonic has the wherewithal and the bandwidth to get those across the line. So I really like the name here. It's, as I said, it's trading around 34.50, still adding to positions for Sonic. Quickly moving on, Ansell, personal protective equipment company. Just like Sonic is a key beneficiary, Ansell, of the COVID pandemic. This is personal protective equipment, PPE. We all know the acronym nowadays by heart. Obviously, like Sonic in testing, PPE is not going to fall off a cliff. And people believe, oh my gosh, it's run up so well. There's 4 upgrades last year for Ansell. It's done extremely well. We upgraded it coming out of the first half, thinking there's more upside. But people are forgetting, the PPE will come down, just like Sonic in testing will come down. Not necessarily fall off a cliff, as I wanted to point out. But another half of the business that people forget for Ansell, it's our quasi-industrial name. Actually has 40% of its profit coming from industrial production. And you see industrial production picking up across the globe. A lot in the US is doing quite well. That's going to help a provider like an Ansell. So like Ansell, I think it's in a sweet spot. Both of the COVID trade and that reopening trade have a momentum on its side. Conservative gearing on the balance sheet is really good. Net debt to EBITDA only 0.7 times, really yielding almost 3%. And trading below our market multiple. What's not to like about Ansell? Remain buyers there as well. Turning quickly to specialty pharmaceutical company CSL, arguably the best-in-class operator, arguably should be in every single person's portfolio. Definitely a core holding here. Upgraded that to an ad a couple of months back at 250, written it up now 15%. Good to see that it's worked, but I think it's just a rotation from investors looking for a little bit of safe haven amongst inflationary concerns. But right now, remember that the story for CSL is about plasma. This is the liquid gold by which this company generates most of its profit, and a majority of its products are derived from plasma and plasma collections, namely out of the United States. Unfortunately, it's very hard to get a feel for where plasma collections are currently. They were down year over year. You get some insight from the companies like Takeda that have recently reported. They reported a 5% fall, however, in their plasma collections in January through March, but improvements in March through April, so that's a thumbs up. But then we have a key equipment supplier to the industry, Haemonetics, also reporting a 13% decline quarter over quarter in their collections and softness through April. So once again, it's very hard to get a read on where things are going to flush out. And it's all depending on the earnings outlook for CSL, or dependent, on that outlook for plasma, where earnings go for CSL. And you throw into the mix, you have the U.S. stimulatory checks, you have the child tax credit that's kicking in here in July, you have extensions of unemployment benefits through September, really reasons for people not to give donations, but it will change. I've always said these are not structural headwinds, they're temporary headwinds. So I still like CSL, but there's near-term risk. And I've said coming into the fiscal year end, where the rubber really is going to hit the road, where in August they're going to report their fiscal 22 outlook. And I've always said I think consensus is a little overly optimistic, 10% plus growth. We're sitting at 7%, so 3 points below consensus. So we're thinking that there's risk heading into the year-end result. That being said, just like Resmed, CSL momentum, I think is going to carry it higher. So I kind of play this. You need to be a little nimble, around CSL with trading if you're going to trade this name, given that you have, of course, the uplift with a safe haven, and of course, heading into year end, if there's downside risk in their outlook, the shares will come down, but then instantly they get hoovered back up. So that'll be a little nimble around that name. And just quickly, I'll end with Volpara, a small cap name that did put up year-end results yesterday. Now, nothing really too concerning. The key metrics are really pre-release, but really the annual recurring revenue was up 55%. Really good to see it's moving in the right direction there. And really what we're looking at, the annual recurring revenue per unit was up 35% to $1.40. Like I said, moving in the right direction as well. Threw up some 22 guidance, calling for 30% growth. We believe that is more than achievable given their annual recurring revenue is around $28 million, so almost right there as well. So we're going to maintain our ad rating on shares of Volpara, like the name there.